You might have heard that the government wants to give your baby some money, $1,000. And depending on where you live, the Dell family might add another $250 on top. Hi, I'm Ann Garcia. As a certified financial planner and author of How to Pay for College, I've helped thousands of families save millions of dollars on college. If your child was born in 2025 or later, there's a brand new account with their name on it and free money inside. But before you rush to put more of your own money into it, you need to know more. Last year's One Big Beautiful Bill created a new account type, the 530A, better known as a Trump account. Think of it as an IRA for kids. Any child who's a U.S. citizen under age 18 with a Social Security number can have one, with a parent as custodian until they turn 18, at which point it converts to a traditional IRA. There are a few key features. First, contributions are capped at $5,000 per year total across everyone who contributes, family, friends, employers. Unlike a regular IRA, your child doesn't need earned income to contribute. No paper route, no babysitting money required. And the money's locked up until January 1st of the year they turn 18. And after that, penalty-free but taxable withdrawals are allowed for college, a first home purchase, and a few other uses. Now, the headline, every U.S. citizen born between 2025 and 2028 gets a $1,000 federal seed deposit. On top of that, kids under age 10 who live in zip codes with a median household income under $150,000 get a $250 contribution from Michael and Susan Dell. That one's limited to the first 25 million activated accounts, so there's a reason to move quickly. Employers can also contribute up to $2,500 a year, which is tax-free to you if they offer it. Those amounts may sound small, but project them out, and that seed money could be worth about $5,000 when your child starts college, $12,000 at age 30 when maybe they're looking at a first home, or nearly $200,000 at retirement. The only catch, you have to open the account to get the money. You can file IRS Form 4547 with your taxes, sign up at trumpaccount.com, that's accountsingular.com, or through the Trump Account app. One warning, there are lots of similar sounding websites out there, so make sure you're on the right one. I'll put the correct links in the description. But here's where I want you to pump the brakes. Should you contribute your own money? That's a completely different question, and it starts before we compare any accounts. Remember the savings hierarchy. Emergency savings comes first. You need that cushion before anything else. Then your own retirement. Remember, as the saying goes, there are loans for college, but no loans for retirement. Only after those are on track does saving for your kids' education come into play. And Trump accounts, those are really a long-term gifting vehicle, so they fall behind all of those. If you haven't checked those first boxes, that's where your dollars belong, not in any kid's account, this one included. But let's say your emergency fund and retirement are on track and you're ready to save for your kids. Even then, this account has issues. A 530A is tax deferred, not tax free. When the money comes out, the earnings are taxed as ordinary income. And if your dependent child uses it for college, the kiddie tax may apply, meaning some of it gets taxed at your tax rate. Next, your after-tax contributions create basis that you'll have to track because every withdrawal is prorated between basis and earnings. One more quirk, contributions don't qualify for the annual gift tax exclusion, so contributing to this account means filing a gift tax return. Let's compare that to options we already have. For college, a 529 wins. Qualified withdrawals for tuition, fees, room and board, books, even K-12 tuition and apprenticeships are completely tax-free. And many states give you a tax break for contributing, which you don't get with the Trump accounts. For retirement, a Roth IRA is even more powerful. Roth IRA withdrawals are entirely tax-free, and contributions can come back at any time. And here's a strategy I love. Fund a 529 now, then once your child has earned income, even if it's from babysitting or mowing lawns, you can start rolling those $529 into a Roth IRA, up to $35,000. For flexibility, a UTMA account doesn't have the tax advantages of a 529, but the money's available for any purchase, education, a home purchase, or leaving it for retirement. Let's run the numbers. $1,250 invested at birth at 8% annual return grows to nearly $200,000 by age 65. In a Trump account, someone in the 22% bracket owes roughly $44,000 in federal taxes on that withdrawal, leaving about $156,000 before state taxes. In a Roth IRA, they keep every penny. So here's my bottom line. Open the account and take the free money, the federal $1,000, the Dell $250 if you qualify, and any employer dollars. Never turn down free money. But your own dollars, follow the hierarchy. Emergency savings, then your retirement, then your kids. And when you are ready to save for your kids' future, a 529, a Roth IRA, or a UTMA will usually serve you better than a Trump account. If this video helped you understand Trump accounts, do two things. Give it a like and subscribe so you don't miss the next one, because we've still got plenty to get through together. I'm Garcia, and I'll see you again soon.